Good day, ladies and gentlemen, and welcome to the show. Today is Tuesday, the 9th of March, 2021. Thank you for tuning in. I'm going to tell you guys, there is tremendous energy in the system right now for everything to fall and collapse. It's unbelievable how much downward pressure is on everything. Well, it's obvious we are in an everything bubble. And the bubble is just the skin of the bubble is just stretched so tight, you know. But will it collapse? And a few months ago, I was telling you guys that it's not going to collapse by 80%, 90%. It can't. It can. It can. It can, but it can't. It can't because they've got an unlimited money printing ability, and they're not going to let it. It would. It would. It would collapse. And these economists out there are seeing all this downward pressure and they're saying, oh, it's got to collapse by 80%, 90%, or 70%. Yeah, it needs to. But that's not the I'll say politically correct thing to let happen. They're not going to let it happen. They can't let it happen. The system would just, we would look like Mad Max. I mean, the whole thing just can't, they can't let it collapse like that, not with the way it's leveraged, because everything would go bankrupt. All the banks, everything. They can't withstand it. The system can't withstand it. And the system can't withstand interest rates going up now at this point either. So they're not going to let interest rates go up. There's no way. And, I've been saying this for weeks. I tell you, and now we're starting to see the actual results of all of this. We're starting to see that inflation's starting to come just the first little trickles of it. But a tsunami of inflation's coming. That's what's coming. But the dollar is so big, guys. Worldwide trade, the dollar is the numero uno. It's a sumo wrestler. It's not going to fall real fast. It's going to be a slow process. This is going to be something that's long drawn out because the dollar is so big in world trade. And I think we're right at the starting gate right now. Now, going back a few months ago, I said about the economic recovery, I said there is a danger of a collapse. And I said it was the first January, February, March. We're in that danger period. Well, we're starting to get toward the end of March now. First quarter's almost over. And we're starting to see the light at the end of the tunnel as far as the collapse is concerned. And there won't be so much danger of a collapse once we start to get into through the next quarter. Let's get started. Let's open up the charts. Let's open up the charts right here and take a look at what's going on. The Nasdaq's exploding higher, and this article comes from Zero Hedge. But what I really want to point out about this article is what they say right here. It says, as we said last night, it appears the world's central banks have drawn the line in the sand. No more than a 10% drawdowns, and life is good. In other words, what they're saying here at Zero Hedges, they're not going to let it go more than 10% down, anything, in this huge bubble. Now, I've been thinking to myself 20%. And I'll tell you why I think 20%. I think it could drop 10% because there's so much leverage in the system. It could drop 10% quicker than the Fed could react. You could have Chairman Powell out sipping a cup of coffee at some restaurant someplace, and it could drop 10% before he could get the zip down. It takes them a little while to react, but they're not going to let it drop too far before they come in and they do react, and they're going to do something. And the more it drops, the bigger whatever they're going to do is going to be. They got more tricks than you could possibly imagine to throw at this thing. Things you've never heard of before. And things that they can sit around the table and make up. The next day, some new program is started. But here's the thing, guys. they're trying to cut back on some of these programs that they did put in. If we take a look here, the Federal Reserve is to close most of the COVID crisis emergency facilities that they set up. They set up these 3 lending programs are set to expire, it says here, as scheduled at the end of the month, citing low usage. The Commercial Paper Funding Facility is one of them. The Money Market Mutual Fund Liquidation Facility and the Primary Dealer Credit Facility were launched in March of last year to combat the turbulent trading conditions. See these turbulent trading conditions in the MOVE Index. This is up my window into the credit markets. It's been steadily rising lately. You know, it's been getting up a little bit hotter and hotter, the MOVE Index, you know. 75 is where the markets start to show signs of instability. I'm thinking to myself, hey, maybe they acted a little bit out of haste, you know, in closing these facilities so quickly. Perhaps they should have extended this a little bit longer. These programs that they're scheduled to end at the end of the month. Because we're just coming out of the woods now, and they're acting kind of quick closing these down. Anyway, let's get in there and take a look at what's going on. 82 cents up for silver today, 25.92. Looks like it's peaked right now. Might move up a little bit higher this afternoon. But we got an 82 cent jump in the price of silver. Okay, gold. 17.13. It's up 31 bucks. That's a pretty good little jump in the price of gold one day, you know. Okay, let's take a look at cryptocurrencies right now. We're looking at cryptocurrencies have been creeping up and up and up. 53,972 for Bitcoin. 1,681 billions in the market. That's 1.6 trillion. Here's the thing. Pretend you're a money manager or whatever, you know, and you got $100 billion or whatever that you're taking care of, you know, and you want to buy something that's, you see the dollar starting to depreciate in value. And you want to buy, you want to hedge for your clients, you know, out of the dollar, which is not a simple thing to do, because there's only 3 asset classes that are preferable for a hedge fund manager to hedge out of the dollar. So you're sitting at your desk, and you're gonna hedge with say $1 billion a hedge, $1 billion, you know. So you got your choice. You get gold, silver, or cryptocurrency. Because those are the only 3 really good hedges that are completely out of the dollar and don't have any counterparty risk. But now remember, you're a hedge fund manager. You want to invest $1 billion, right? So your buddy comes over. He says, well, what are you going to buy to hedge? And he says, well, I got these 3 things in front of me. They're out of the dollar because we got to hedge out of the dollar. We got Bitcoin over here. We got gold here, and we got silver here. Right? So he picks up the phone. He says, I'm going to buy gold. That's my first gut reaction. Picks up the phone. The other guy says, hey, wait a minute. You're going to buy gold. How much gold are you going to buy? $1 billion worth. Yeah, okay. But you know that's not really out of the dollar. When you buy those, you're going to have to buy SLV, you know, and it's a paper. It's paper, and they're going to settle with paper. They can't settle in real gold. Says, oh, yeah, that's right too. Well, what are we going to do? Well, let's buy real gold. Let's buy the real thing. So he picks up the phone. He calls up, what's the biggest gold corporation or whatever, the people that can deliver the most. He picks up the phone. He starts talking to him. He says, I want to buy $1 billion worth of real physical gold. And he hears this laughing on the other end of the phone. What are you laughing for? You can't. Because where are we gonna allocate $1 billion worth of gold? I can't. I'm sorry, I can't fill that order. In fact, he says it's a joke. The guy on the other end of the phone says, "Well, how much can I buy?" Well, he says, the market's awful tight right now. And when do you want delivery? Well, as soon as I can. Well, I'm afraid 6 weeks will be the soonest I can get it to you. Oh, he says, my clients, and everything. He says, this is impossible. I can't buy real gold, he says to his buddy standing there next to the phone. I can't buy it. Well, let's try silver. So they go through this rigmarole trying to get some physical, right? Can't get it. At least delivered or anything. So, and then they start to talk to each other. They say, well, where are we going to put it? When we buy this $1 billion worth of, where are we going to put it? I don't know. You need a vault for that, don't you? Yeah? Oh, maybe we can't buy this. This is pretty difficult for us, isn't it? Because we're trying to buy $1 billion worth. I guess it can't be done, he says to his buddy. Yeah, the guy says, yeah, I guess we can't. Well, we'll have to scrap that idea. We'll have to scrap the idea of buying gold and silver. Picks up the phone. And he says, let's buy some Bitcoin. He says, sure. He says, listen, though, I don't think you need to call anybody. You can just buy it online. He says, hey, is that great? He says, yeah, just push this button here. Pushes a button, click. And it says you purchased $1 billion worth of Bitcoin. He says, there, you've done it. Job done. Let's go for lunch. So much easier to buy for these guys that are in the financial system. Now, I just give that's not really the way things are done, But it has parallels in truth of what these guys are facing, these guys that are that have billions to spend. Not millions even, but thousands of millions of dollars to spend. This is what the dilemma that they face trying to buy real physical. And I use this to demonstrate to you guys how much easier it is for them just to push the button on crypto, rather than go through all the rigmarole it would be to try to actually buy physical metals. And if they really want to get out of the dollar, they're not getting out of the dollar by buying physical metals when they buy the paper short contracts. Because they're all going to be settled in dollars. And these guys know it. So this is part of the reason why we're seeing all this upward institutional investor pressure on the cryptocurrencies. And it's probably going to continue. Whereas the gold and silver, what's really holding gold and silver behind is the fact that it exists in the real world. And we've moved into a digital financial system that nothing exists in the real world. It's all play money that exists online only. And this is where these guys deal nowadays. They don't deal in real. Now, part of what makes gold and silver so nice is the fact it's real. And all this other stuff, including Bitcoin and everything else, is not real. None of it's real. The whole financial system now has all gone digital. It's not real. It only operates in cyberspace. But once you get that set up so that everything operates in cyberspace, then these guys that operate in cyberspace, they don't want to deal in reality anymore, which is where gold and silver is. And this is part of the reason why gold and silver is struggling so hard. But it's never going to go out of style, and it's going to catch a bid at a certain point. Really good bid, But cryptocurrencies, their tendency is to outstrip it. Even though it will catch a bid. And the bid is going to be explosive when it really finally does come, and gold and silver really get unhinged from these paper short contracts. It's going to be explosive, the moves to the upside. Now, they've already prepared for this. They've put in stops in place because they knew this was coming, so that they can stop the price movement to the upside. Anyway, that's all part, as far as I'm concerned, that's all part of the rigging operation. Cryptocurrency, now we're going to take a look at the Dow Jones today. 32,095. I'm going to tell you guys what. What's more likely than an 80% crash in the Dow Jones? What's more likely is that the Dow Jones goes to 50,000. Is much more likely. So it's at 32,095 right now. It's up 293. The Dow Jones is hyperinflating before the dollar. The dollar will come. This hyperinflation will come. Crude oil's at 64.47, and it's dropped 58 cents today. Let's take a look at the MOVE index. Now, here's what I was telling you about. This is the credit markets. And we're starting to see it get up near 75. 75 is my marker that I've put in. Anything above 75 is instability in the credit markets. So we're getting up real close to that instability beginning. And it's moving up. It's up 2 points today. 3.28%. Bonds and rates today. We're seeing a little bit of pressure come off of the bonds. But I've told you guys, they're not going to let this go up. They will not let this happen. I think that their markers is on the U.S. 10-year is the most important. And I think they probably have a marker at 2% and 2.5%, and they already know what they're going to do. So if the U.S. 10-year goes over 2%, they're going to have probably one reaction to try to lower it. And if that don't work, they probably got Plan B at 2.5%. And Plan B is probably really draconian to bring it down, you know. Take a look at U.S. dollar index at 92.10. It's been drifting downwards today. And, well, that's your show for today, guys. Thank you for listening. Like and subscribe. Give me a thumbs up. Hit that notification icon. Gee, that's a lot of stuff. And we'll catch you guys in the very next episode. Bye-bye.